Hey folks, it's Oz from GNAT-TV. Today we're in studio and I'm talking with Todd Walker. And Todd, what's your line?
I am a financial advisor and I specialize in socially responsible investing, and we have a firm named Greenvest.
And he's going to be helping us through the next 20 or 30 years, giving us financial advice. So we're going to shoot a number of segments today, so you won't see us changing our clothes, just so you know. And Todd, for the first segment 1, segment 2, and probably segment 3, it's all going to be on sort of the same topic. And what is that topic?
Well, it's about the essential principles of investing, instead of just relying on stock tips and things like that. You know, how do you successfully invest based on professional disciplines?
Right. So instead of taking the cabbie's advice, you're setting up a system that hopefully leads to success.
Right, because when you take stock tips or just random thoughts, oh, that looks like a great company, or I buy their products, you're at best probably getting a 50-50 chance of success. 50% of gains, 50% of loses, and over time that cancels out. And so the best you can do is break even. So what investment professionals, and especially those managing huge amounts of money, you can imagine billions of dollars, have to come up with systems that increases the probability of success. That's really what professional investing does.
Probability.
Yeah.
Right.
And it increases that probability from 50% till, if you invest in a long enough period, it's very close to 100% that you'll probably have some kind of gain if you invest in enough diversification and for a long enough period of time. And I'm not talking about 30 years, I'm talking about 10 years.
Got it. Okay.
That you can be much more successful.
Okay,
Yep.
so take us in.
Okay, well, as you know, I get questions all the time from clients, and over the years have come up with all sorts of ways to explain things that I found are a little more, get better reception than just dry investment talk. But we're going to go through sort of the essential principles to set up for success. So the first thing, people come and they want to get investing, but the first thing I ask is, do you have an emergency fund? So, and this is based on being a fiduciary. People, if you don't have something in savings that's an FDIC insured, protected, you don't want to be in the market. You have to because the market is volatile, and you want to know that when you take that the money will be there when you want it. But it's not that it's going to disappear, but that it might be just down in a decline period. You don't want to take it out then because you don't have a chance to get back up.
And this emergency fund is not an emergency to buy stocks. It's an emergency to fix your broken leg. I don't know.
Well, exactly. I mean, food, medical emergencies, et cetera. So it's there so you then can go forward with more confidence into the market.
Like, how much should I save?
Well, 6 months to a year living expenses.
Okay.
And then at that point, 6 months if you feel confident, a year if you feel that you need more money, and then from then you go into the market. The only caveat to that is if you're a young person, because you don't have an emergency fund, you want to get started with investing. So you have to sort of do both at the same time because you want to get in the market. You don't want to give up that time you have of being a young person to get that compounding growing over time. But understandably, you don't have 6 months maybe to a year. So it's just a little caveat.
And it could take you so long to save that 6 months a year because your job pays so badly.
Well,
that it could take you a couple years to finally get that. And what you're also saying is you're not in the market for those 2 years.
You're not in those markets. And that's critical to be in the market when you're young. The other thing is to establish a risk tolerance. You have to figure out what's your comfort level. And the comfort level is usually based on, can you replace this money? That's the way I explain it. People say, well, you're aggressive and conservative or whatever. The real way to say, can you replace this money? And again, when you're younger, you can be much more aggressive because you have more time. But the other reason is because you're going to have all this income over your life to replace any bad investments you make. But if you're older, it's retirement money. Obviously, you can't take the risk. So that's why I get clients coming to me that say, well, I think sometimes they want to act like they're more aggressive than they are or something because that may be a better thing than to say you're conservative. I don't know. But they'll say something, but then when you really ask that question, well, can you really lose this money? They'll go, oh no, no. And you're like, no, you're conservative. That's
Right.
it. So it's a better test. Again, knowing that we don't have that much time, I'm going to race through these a little bit because some are obvious, but some it's good to just get these fundamentals as you sort of march into the market. The other one is, do you have a 10-year investment horizon before you get in the stock market? And that always surprises people, or sometimes, because if the stock market traditionally has this 10-year window that it does return money, there's been one period that did not, then you don't want to expect to take money out before that, because again, it could be in a decline, and you don't want to pull it out during a decline. So if people say to me, oh no, we really are saving for a house, this is for a house or a college or something, and I'll say then you don't want to be in the market. Or very conservatively in the market, maybe just bonds, but not stocks. So next, as you build these building blocks of investing, is who will do the investing? Do you want to do it? Do you going to hire a professional? Are you going to have a mutual fund do it for you? Are you going to actually do a financial advisor who works for you personally? So it's just...
Or your company through their 401, do they sometimes try to do it?
Yeah, that's another group. That's actually in a way a mutual fund. But yeah, where are you going to invest?
Got it.
Are you, and who will you choose and why? And we'll get into that in one of the other segments as to how to hire a financial advisor if you wish. The next thing is, where to put the money. Where do you start? What do I invest? Everybody's asked you to invest with them. Insurance companies, investment companies, banks, et cetera. Where do you put the money? And I think that we talked about the emergency fund, so that would be a bank, right? The next place, the first place that when you start investing is someplace you can get free money. Which is, again, this is the way I've come to explain things to people. They kind of go,
"What? Where you're going?
That sounds interesting,"
Right.
What I mean by that is either a retirement plan, an IRS qualified plan, an IRA, a SEP IRA, a solo K, something like that, or your employer's plan.
The 401.
A 401k.
Got it.
So, and typically the first place within that group is going to be your employer's plan, because most often today there's some kind of employer match. You put in so much, they match up to, you put in 3%, they match that 3%, and you can put in more.
Right.
Well, that's just found money.
Right.
That's, you would be crazy not to take advantage of that before you invest on your own. So you want to max that plan out as much as you can. If you don't have an employer plan, then you have vehicles available to you like a SEP IRA, which is an employer plan.
And a quick question on that.
Yep.
So the employer matches you up to 3%.
Yeah.
You probably can put in more.
Oh, yes.
But probably you shouldn't, because you're done getting the free money, and maybe now it's time to switch to the IRA and get the tax break?
Yeah, it's an interesting question. It's an interesting question. And especially if we deal in social responsible investing. So some plans employers are getting hip to that, and there's choices. Many still don't. So in that case, you get the match, and then you might move over to your own plan that you could do specialize in SRI. Right. But it depends on the choices at that point. What does the employer offer as investment options, and what can you do yourself?
Can I have a 401 and an IRA at the same year, side by side?
You can up to certain limits.
Okay.
To make it simple, the government's not going to allow you to go up to the max on your plan and the max on an IRA.
Gotcha.
And get you to and have you deduct all of it. And I'll just a quick mention. There's also within these choices now Roth IRAs. Well, they've been for quite some time, and that is a regular IRA, a regular 401k. You put so much in, and then you're allowed to deduct that against your income. Right, but eventually, and then that grows tax deferred, and eventually you're going to have to pay that money back.
That's right. So whether you get the tax break today or the tax break 40 years from now, you're still going to have to eventually pay taxes on something.
No, not with on that one, but not the Roth.
But not the Roth.
Roth is tax-free forever.
Forever, because you already paid the taxes.
Yeah. In fact, a big benefit of Roths that not many people know about is that they're tax-free to your heirs as well. So one of the best gifts you can give your children is to save for a Roth.
Listen, that wasn't there when I was 20.
I know.
All right, wait, I'm taking you away.
Maybe it was. I don't know.
Okay.
But anyway, so a Roth is also like for young people, the Roth is almost always the best answer, because over time, But the person to ask about this, this choice is your accountant. So the accountant, we work closely with them, and we don't, we'll suggest maybe you should be doing more in the retirement plan. Then we'll say, now let's go to the accountant, and the accountant's going to decide which vehicle. And the accountant can also weigh in on the company plan too. Anyway, that's the first place to put money.
Okay. 401.
And then from there, you start opening up maybe taxable accounts or things like that. And the last one, we were talking about, well, how much to invest? And then that's the question you get a lot. How much should I put in? How much should I save? And what I've come down to is that basically, this is not absolute, figured out to the dollar. But my experience has been if you invest 10% of your earnings every year, you probably don't have to worry. I mean, you're going to get to retirement with enough money to continue your lifestyle as you had before. So 10% of what you earn, you put away. And you think, well, that doesn't sound like that much. But believe it or not, if you did that, you'd be saving more than most Americans that just do not save that much per year.
Sad.
Yeah.
So that 10% over time, just out of curiosity, so it would probably allow you to continue your lifestyle that you had lived, or
yes,
could it build so great that it might actually afford you a higher living standard in retirement, or is that tricky to ask?
Yeah, tricky because legally we can't promise for
Right, you can't promise anything. But
yeah, that's the one because of so many factors. But that's why I said 10. I mean, it could be the stock market has grown an average of 10% a year over time. Right. It was 8, but this latest 10 years since 2008 has just been way up. So that the market, but 10% growth. So don't forget, you're getting the 10% you're putting away plus 10% growth of that. So this is the compounding that starts happening. That's why. So if you just, people say, well, how much should I do? The max from a 401k is depending on your situation, around $16,000. So that may be more or less than 10%. Obviously, if he's more than 10%, then go for it if you want to. Never had, as I was saying to you earlier, never heard a client say, God, I saved too much for retirement. I'm really upset. I don't know what to do.
I'd like to say that.
I know. It's always usually the other way. So I think because if you save too much, then there's charities. I mean, you can.
And this 10%, because it also sounds like you're saying is that we're always assuming that this 10% only works if you have a lot of money. But what you're saying is that a person who may not have a lot of money, if they can still pull off this 10%, they can still end up having the life that they have,
that they want,
right?
I mean, they'll be. I can't
so
start mapping out exactly, but they can take vacations and have their house.
Right, but the point is just because you don't make a lot of money doesn't mean you can't do something about it.
That's it. Well, that's a good way to put it. I mean, a lot of people say, well, we don't have much; it won't amount to much, But it will amount to the most critical thing that you want, which is financial independence,
right?
Financial freedom.
Feeling.
The end. At some point, you want to just be able to say, look, I've all this years of my life I've been accumulating and and helping my family and everything else, and now I just want to kick back and do what I want to do. I want financial freedom to be. It may be helping charities. It may be traveling all the time. It may be starting another company, believe it or not, just because it's fun. But it's the freedom to decide what you want to do, and that's really what all this is about. This is what is it, giving yourself. Not become, well, and especially with our clients, socially responsible. It's not about becoming super wealthy. It's about being able to move on to higher levels, like Maslow hierarchy of needs.
And moving some of the fear from your life.
And removing fear from your life. Boy, I didn't realize how good my profession.
Right, that's actually crucial.
Yeah, but it's true. It is about fear, and so we're trying to remove fear in investing, so that you can remove fear in your life. I got to write all this down.
All right, so I'm dragging you off. So where are we at? Where are we at in this?
So I'm sorry. So this is about there's a lot more, but you'll have to tune in next week.
Right, because we're that. So in segment 2,
yeah.
What are we going to be dealing with in segment 2?
Well, we're going to go on and at this point we've got these building blocks, and now we're essentially going to say, let's start building the portfolio. Let's actually start fleshing it out. What are you going to pick? How are you going to allocate it? How are you going to diversify? There's other parts of this discipline.
That's sort of the nitty gritty.
It's the nitty gritty.
Right. That's where the,
Yeah. But before that, I just wanted to get into, don't be afraid of it, and
Right.
you know, and that investing willy-nilly, just even if you hit some giants, it's just never going to get
I
you as
know.
much as if you just have more discipline.
I did that in my younger days and failed horribly.
Oh.
All right, Todd, thank you so much.
All right,
Everybody, we're
thank you.
going to see you next
Thank you.
time, and thanks for watching.